Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about, see the news that people are sharing. I'm going to give you my financial opinions as we go about. It's going to be commodity, financial, or wealth building related topics. So let's dive in. We're going to go dive in right now, check to see what people are talking about. And again, if you want to follow me, it's at finding_finance. And if you need any help with anything, you can check out our community, finding-value.com. We still have that 50% discount coupon. I extended it for those who still want to join up and try it at a 50% first month discount. So we've got Tavi here. Tavi's been just killing it, guys. This guy has been giving lots of information that is dead nuts on. Good work, Tavi. I think I asked him to come on the channel too, so he'll be coming on at some point. So it's time to redefine traditional portfolios. The valuation history of the 60-40 portfolio unfolds through extended cycles, and now we are now experiencing another critical juncture in this dynamic. So this is the earnings yield cycle for the 60-40 portfolio. You can see that we were at the lowest yield in 130 years. So basically what this is that big, great rotation of money that I talk about. And if you notice, the top was 1981, and that is when yields had peaked. It's the end of the stagflationary era. We came all the way down here in a correction. You can see it's an A, B, C correction. Nice big correction there. All the way down to these lows in 2020. What drove that is the decline in interest rates, the 40-year decline in interest rates. That is what drove these valuations back down here. Now, what's going to happen going forward? In my opinion, with the increase of yields, it's going to rotate this 60-40 portfolio back into precious metals and commodities. And that is going to be the driver of money flows. It's going to come from here into precious metals and commodities that I've talked about for the past couple of years. That's the great rotation. Some people call it the big long. The big long is where you want to go long precious metals and commodities. That's the new name of it. It's called the big long. So that's the earnings yield for 60-40 portfolios. He's got a lot of information down here. This is the valuation history. We are at a 130-year high. 130-year high. We are coming back down due to the 40-year long decline in interest rates. He says to put current valuation and balance into perspective, its recent peak was a staggering 61% higher than its previous peak in the early 2000s. So coming on down, we've got U.S. equity market. This is your CAPE ratio. The CAPE ratio is the price to earnings ratio. You can see that we're at very high levels here, 35. We're coming back down, and I think that we're going to head lower in the CAPE ratio as interest rates head higher. And they are inversely correlated. The way that we got to these ludicrous valuations is interest rates. We can see that it bottomed in 81, 82, 83 in this area here where the price to earnings ratio was very low. The reason it was low is because interest rates were very high. People didn't want to speculate in stocks. They'd rather put it in bonds and get a 15, 16, 17% return on bond yields, on frickin' bonds. And that was the best time to buy bonds, was during that time frame in the early 1980s. Coming on down, it says the shifting dynamics of capital moving away from crowded equity and fixed income holdings as investors seek new investment opportunities could have profound implications in the market. This is where gold and commodities are poised to play a major role in this transitional phase. Completely agree. He's talking about the money flow away from bonds and stocks and into commodities and precious metals. Coming on down here, it says our treasuries are now more volatile than gold. So it says, nevertheless, institutions should deeply reflect upon this crucial analysis. For the first time in 45 years, US Treasuries have exhibited higher downside volatility than gold. That's crazy. Downside volatility. And here we are, that's 45 years. So we could see a vast outperformance of gold in relationship to treasuries as volatility kicks up and as outperformance comes into play. People just chase performance, guys. And the major driver of the rotation of money is when someone is holding an underperforming asset. They're more likely to sell it when things go down versus than things go up. We've got global central banks gold holdings as a percent of foreign reserves. Look at that rounding bottom, guys. Here we go. We're going to move on up as foreign reserves are going to be greater percentages of gold holdings. So this is going to be good there. So rather than loading the balance sheet with debt instruments from indebted economies, it's imperative for central banks to hold neutral alternative with centuries of proven credibility as a hard asset to become the cornerstone of their monetary systems. During this bottom here, I basically accumulated my entire precious metals portfolio and have been doing ratio swapping in it. And I think that we are going to see a vast revaluation of precious metals against other assets. It is coming and it's going to accelerate at some point. This is your long bottoming pattern. That's that round bottoming pattern. That will eventually come on up. Here's CapEx cycles, technology versus the energy sector. Energy sector is the red, down 71% from 2014. The technology sector is at record levels. This will reverse over the course of this bull market. It will reverse. Interest rates will cause that rotation. This is the commodity to equity ratio. You can see that we just barely came up. We are still cheaper in this ratio than the last bull market in 99. And even in the 70s, we're about the same amount of cheapness. That just means that, one, there's no money over in commodities. It's all over in equities still. Two, the rotation has just barely started. And three, we've got a long valuation runway for this to really progress to the upside where commodities vastly outperform equities. Coming on down, we've got the Japanese 10-year yield. Look at this thing starting to rip higher, guys. Yields are the driver of it. So it's inflation that's the ultimate driver. Yields chase inflation, and yields are going to reprice the equity assets and growth, high growth stocks. Higher yields in the net present value calculations are going to rotate the money over. And we're just about to get started on this. And he's showing the 10-year yield starting to move higher. We've got gold prices in Japanese yen terms. This thing is rocketing higher. When interest rates go up, it causes that rotation of money. And gold is one of the preferred assets because bonds or debt instruments go down when interest rates go up. It's going to cause the big long. Gold in US dollars versus Japanese yen, you can see that we've been holding gold lower with our interest rates rocketing higher and that dollar moving up. That's not going to last forever, guys. You've got a great opportunity here to load into an asset that is just mispriced. It says, in the world burdened by historical levels of debt, it's important to remember that over time, all paper currencies should lose value against hard assets. In our strong view, the yen is just an early mover. So you can see this discrepancy of gold priced in different currencies. Japanese versus US government debt as a percent of GDP. You can see that in the red, Japan is way up there, 255%. And you can see that US is starting to track higher. We're at like 125, 130, somewhere in that range. And that's going to accelerate with higher interest rates and the debt levels that we have. It's going to be inflation from all orifices, guys. Fed's ownership of U.S. federal debt percent. Nobody wants the debt. Nobody wants it. The current monetary policy in the U.S. is starkly misaligned with the surge in Treasury issuance and the prevailing levels of fiscal irresponsibility. So we're releasing a lot of new bonds, but nobody wants to buy them. Even the Fed's like, we'll still buy them, but we're going to slow our rate of percent. Remember, this is the Fed's ownership of U.S. debt as a percent. Even though they're flooding the market with more and more debt, they still are buying a large percent. Here's another one, gold versus the U.S. 10-year yield. Gold spot, U.S. generic government here. You can see that they're both highly correlated. So when you look at yields there, this is the 1970s and 1980 bull market. As yields went up, so did gold. So I think this is what's coming. I think that the relationship that gold has had with yields over the past 40 years is going to break, and that gold will start to move up with yields like it did in the 70s and in the 70s for the most part. And that's what I'm looking for. That's what I'm watching for, is that relationship to link up with yields and gold prices. That means that the money's rotating away from bonds, away from equities, and doesn't really have too many other options to go into. And that's where gold steps into play, and silver and platinum and commodities. So this trend isn't limited to that specific decade, and you can find similar instances in the 1910s and 1940s. 1940s was another highly inflationary period where they had fiscal inflation, and there was a lot of bank lending during the 40s as well. It says, while gold prices may not have been freely floating during these periods, other tangible assets such as commodities demonstrated remarkable performance. So that is what we've got there. God, he's got a lot of information here, guys. A lot of information. Coming down to other stuff, it says increasing rate of changes for wages plus the decreasing rate of change for purchasing power. And what he's doing by using these is he's basically identifying a market condition where silver and gold outperforms. So this is more information that is stacked on top of, that's a big chart. It's stacked on top of what Tavi was talking about. So if we look at wages, purchasing power, and silver, silver went up. This is silver on the top in the whitish silverish color. So silver went up. We had a long consolidation. That's your lowering of interest rates in a smaller demographic. We had a small little baby bull market here, and then I think the big boy's coming. This is your 7-year rate of change for purchasing power. You can see that we had a massive decline in purchasing power in the 70s, where gold and silver went ballistic. Then we went upwards for a long time, and we've broken down recently, and we're heading lower into that change of purchasing power. Everyone can basically feel this in the United States. Obviously, you guys can feel the change in purchasing power of the dollar that you have if you're in the United States. Well, basically anywhere. And this is your 7-year rate of change of wages, and you can see that the wages just broke out and are moving higher. So I think that he's basically charting the conditions where silver can outperform, and silver is coiled up, ready to break out at any point here. And that's what we're waiting for. We've got Grady here. Says this ratio, this is gold versus commodities index. CRB has put in a touch point. It says during big bull moves in gold, gold outperforms the CRB, the commodity index. This is very bullish chart for gold for coming years. This is a Livermore accumulation cylinder. You know what other asset has a Livermore accumulation cylinder? Uranium does. And uranium's already breaking to the upside. Gold also has this chart pattern, the Livermore accumulation cylinder, and we could see a big outperformance of gold versus the commodity complex. So I think this is something that everyone should be watching. And having some exposure to physical metals, I think, is absolutely crucial if something in the system were to happen. And it could be gold, it could be silver, it could be platinum. All of them are good. Another Grady one, this is gold. I know this is very gold related, but are you watching this one? Still holding the blue line. Right above the blue line, and we're just holding right above it. We are sitting on top of, resting on top of a pattern that's ready to break to the upside. Here's commodity, the CRB index. If we were to look at this, he said, play this bull right, get out of the rat race. This is the commodities chart. A little off, so we can just look at this. So this is your big move up. We had a consolidation. Now we're breaking out of that falling wedge pattern, just like we see on our daily analysis. Yields breaking to the upside? Question mark. I saw yields breaking on the 2-year. It looks like they're trying to control it. They probably bought it back down, but this thing was breaking out. It was breaking out on the upside here, and pretty crazy. Now I don't know if they bought it back down to control it, like it was out of control, but yields are about to break higher, perhaps, if we break out of these patterns and do some crazy moves. Here's another one on yields, and yields are driving all this. That's why watching yields is so important. It says, is it sinking yet? U.S. government bonds. This was a valid multi-decade chart pattern. It does have huge implications. 30-year government bond yields, you can see massive move lower in a bullish, expanding, descending wedge that we have broken to the upside. This is your 40-year move lower. This is the driving factor of why equities are so expensive against commodities and other assets. It's yields. It's the demographic interacting with things and the yields falling. Now that has changed. We should all have a paradigm shift of a change to an increasing interest rate environment. I've talked about this for a few years of how this could drastically rotate money differently in the system. And it will. Commodities, precious metals are going to be the best areas to be looking at. And look, the price is broken above the Ichimoku cloud. Like this thing is ready to rip. This is going to be a big change, guys. And it doesn't mean that rates are going to go up straight. They could for a while, but it doesn't mean that we won't get pullbacks either. Kevin, this is kind of interesting here. He says risk off is starting. Good to watch, as I think the QQQs are screwed versus the utilities. Could we be further along in this late cycle move where we're getting a double bottom here, potentially, for utilities versus QQQ, which is the NASDAQ type companies? If this is a double bottom, it means that we're later in this cycle, and that if you were to look at the business cycle and when utilities start to outperform, we could be even late. Like we basically went through a slowdown already, and that utilities are going to kick up, and commodities could slow down at some point out in the future. But this is one where it tells you where you are in the cycle. If utilities really start to take off, it means risk off is starting. That's where, and obviously things overlap, but we could see a slowdown in the markets at some point, where we just kind of went through a slowdown, and it could. This is the slowdown that we went through. We did another bottom, and if we come back up again, another slowdown could occur. So that is something to watch. This guy knows what's going on. U.S. Treasuries are on pace for a record annual inflow of $207 billion and have seen inflows for 31 consecutive weeks, the longest streak since 2010. You will see inflows into treasuries and bonds if there's a scare in the market. And perhaps that's what Powell is trying to do, is scare people into bonds, because he's got to create demand for bonds by scaring people, because he's got to release so much bonds. But I call that a one-time trick. You can't do that forever, but you can get everybody in it at some point for at least one time. After that, I don't know what he's going to do. We've got uranium futures pricing breaking out of an inverted head and shoulders. So we've got a shoulder, a head, and a shoulder, and then the breakout to the upside. Uselink's got a projected move of about $250 on this upside move. So, Jesus, that's a big move. Copper squeezing up, big picture view, big squeeze right into the corner. We'll see where that breaks. Uranium, and what he did is he tied these together: shoulder, head, shoulder, and then a potential break inverted head and shoulders, guys. Could be a very big move there. These sorts of price targets were considered absurd even one short year ago. $200 a pound by 2025. And people are talking about big moves now. Nick Lawson, Ocean Wall spot to 200 by 2025. They're all coming around. And I know Scott and I were early adopters of very high pricing. I think these guys are still conservative. If you were to look at some of the prices compared to history, history is showing that if we were to repeat history, like other bull markets, we're up around the $400 to $800 range or higher, depending on how big the squeeze is. That's not my call. That's just history repeating. I'm not stating that's where the price will go. I'm just stating that that is a possibility because that's what history has done. But 200, I mean, if we have a big deficit, 200 is the weakest bull market we've ever seen in uranium. Do you think a deficit in uranium is going to produce the weakest bull market in history? No. It's going to, you could add, you can multiply this number, I think, by some multiple, and it's probably what it will be. That's my guess. Yeah, I talked about gold enough. Kazatomprom just ripping it. This is one of the viable producers in the world, one of very few. CCJ just ripping it. And then we've got a lot of areas that people I don't think are looking at. Iron ore's been ripping it. Companies like Vale, Diversified Miners, Steel, I think will start to rip it here, guys. Even dry bulk shipping. They all look absolutely excellent to move on higher. This is iron ore. Iron ore breaking to the upside of the falling wedge. It's very cheap against a lot of other commodities. This looks ridiculous. Ridiculous setups all over the place. This is steel rebar about to break to the upside. Absolutely awesome. Everything is kind of setting this up. So I'm going to end it there, guys. A lot of opportunities in the market. It was very gold, silver, precious metals heavy. This one, lots of opportunity there, guys. I think we're bottom. I think we are slow. Basically resting, waiting for a break to the upside, just waiting for the right market conditions. That utilities to QQQ ratio, if that starts to come back up, that's when gold and silver rip it too. So we can watch all this information and see how they're working against each other. The assets, how they're basically performing against each other. And if we see utilities start to rip it against QQQ, we're in that risk-off phase. That's where I would go heavy precious metals. So hopefully you guys enjoyed the clip. Give me a thumb up, subscribe to the channel, subscribe to the website if you'd like, and we'll catch you guys next time. This is Finding Value.